Right now, an algorithm you've never seen is deciding what you can do with your own money. Not tomorrow. Right now. You think your bank account belongs to you? It doesn't. And it hasn't. Since December 23, 1913. The cage was built before your grandparents were born. The digital locks were just added in 2024. By the end of this, you will never look at your bank balance the same way again. Jekyll Island. November 1910. 7 men stepped off a private train car on the coast of Georgia under fake names, with no press, no public record, and no democratic mandate. Between them, they controlled an estimated 22% of the world's entire money supply. For 9 days, in complete secrecy, they designed the financial architecture that would, 1 century later, become the algorithm now watching every transaction you make. They didn't call themselves conspirators. They called themselves engineers. And what they engineered was a systemic transfer of financial sovereignty, away from the individual, away from elected government, toward a single centralized institution that would answer to no one. That institution was signed into law on December 23, 1913, 3 days before Christmas, while most of Congress had gone home. The Federal Reserve Act didn't pass in open democratic debate. It passed in the quiet, in near-empty halls, pushed through by men who understood that the most inescapable systems are always built when no one is watching. From that moment, the US dollar was no longer a government instrument. It was a Federal Reserve instrument, a private entity, unelected, unaudited, and unanswerable, now held the sovereign authority to expand or contract the money supply at will. To decide, with a single interest rate adjustment, whether your savings grew or silently eroded into nothing. The cage had been drawn. But in 1913 it had no sensors, no real-time enforcement, just walls. That changed fast, incredibly fast. The genius of the original design wasn't force, it was dependency. Every American bank instantly needed access to the Fed's discount window to survive any financial stress. And the price of that access was total compliance. Follow our rules, accept our oversight, operate within our framework. The cage didn't need locks when the occupants couldn't survive outside it. By 1920, just 7 years after its creation, the Fed demonstrated what this sovereign power actually meant. It raised interest rates sharply, contracting the money supply with a precision no financial system had experienced before. Farmland values collapsed by nearly 40%. Tens of thousands of rural banks failed. Millions of Americans lost their savings, not because of anything they did wrong, but because an unelected group of men turned a dial. The cage had drawn its first blood, and almost no one understood what had happened. That was the true calculus of the design. When your savings vanished, you blamed the economy. You blamed bad luck. You blamed yourself. The architects had built a system capable of enormous harm that remained completely invisible as its cause. Invisible cages cannot be rattled. This is the pattern, the sovereign sequence, that repeats across every act of this story. Every crisis the system creates becomes the justification for expanding the system. Every failure becomes a mandate for more control. The Great Depression proved it. The Fed's mismanagement contracted the money supply by nearly 30% between 1929 and 1933, turning a recession into catastrophe. Over 9,000 banks collapsed. Yet the Federal Reserve didn't just survive. It emerged with greater centralized authority than before, through the Banking Acts of 1933 and 1935. The cage nearly suffocated its occupants. The response was to build more cage. That was the policy era. Slow, bureaucratic, operating at the scale of years. The new cage operates at the speed of milliseconds. It isn't built from interest rate decisions debated in boardrooms. It's built from algorithms. And an algorithm closes before you've even realized you've moved. The original cage was built from policy. Slow, bureaucratic, operating at the scale of decades. But policy has a weakness. It requires humans to enforce it. Humans make mistakes. Humans can be challenged. Humans can be outwitted. Algorithms cannot. The transformation from a policy-based cage to an algorithm-based cage didn't happen overnight. It happened in stages. Each stage justified by a crisis. Each crisis conveniently deepening the systemic reach of the Federal Reserve into your daily financial life. And by the time most people noticed, the transformation was already complete. The first major expansion came in 1970, when Congress passed the Bank Secrecy Act, the first federal law requiring banks to spy on their own customers and report suspicious activity directly to the government. Not to a judge, not through a warrant, directly. Banks were no longer just financial institutions. They became, by law, the surveillance arm of the Federal Reserve System. Every transaction you made was now a data point in a file with your name on it. But even in 1970, the surveillance was still manual. Paper forms, human reviewers, limited reach. The cage had grown taller, but it still had gaps. The gaps began closing in 2001. In the weeks following September 11th, the USA PATRIOT Act expanded financial surveillance powers to a scale that would have been unimaginable a generation earlier. Banks were now required to monitor not just large transactions, but patterns. Patterns of spending, patterns of withdrawal, patterns of transfer. The threshold for reporting dropped to $10,000. And then, through a mechanism called structuring laws, any pattern of transactions designed to stay below $10,000 became itself a federal crime. Read that again. Spending your own money in a way that looks like you're trying to avoid surveillance, even if you've done nothing wrong, became a criminal offense. The cage didn't just get taller, it got intelligent. It began watching not just what you did, but what you might be thinking about doing. This is the calculus of inescapable system design. Don't just punish the action, punish the intent, punish the attempt to remain private, make privacy itself the evidence of guilt. By 2010, the Foreign Account Tax Compliance Act, FATCA, extended this surveillance architecture beyond American borders entirely. Foreign banks in over 100 countries were now legally required to report the financial activity of any American account holder directly to the IRS. The cage had gone global. There was no longer any geography you could move to that placed you outside its reach. The sovereign authority of the Federal Reserve System had quietly become the most geographically expansive financial surveillance network in human history, without a single public vote, without a single democratic mandate. But here is where the transformation becomes something the architects of 1913 could never have imagined. Because everything described so far, the Bank Secrecy Act, the PATRIOT Act, FATCA, was still fundamentally a human system. Humans writing reports, humans reviewing files, humans making decisions about who to flag and who to ignore. In 2023, the Federal Reserve launched FedNow, its real-time payment infrastructure, embedding algorithmic transaction monitoring directly into the plumbing of the American banking system. Not as an add-on, not as an optional feature, as the foundation. Every payment, every transfer, every digital dollar moving through the system now passes through an automated monitoring layer capable of flagging, delaying, or blocking transactions in milliseconds. Faster than any human could review them, faster than any lawyer could intervene, faster than you could even realize your money had been stopped. The cage had always had walls. Now it had a nervous system, and a nervous system that operates at the speed of milliseconds doesn't just watch you. It responds to you, in real time, invisibly, with no appeal process you can reach before the damage is done. The policy era gave you time to fight back. The algorithm era doesn't. There is a specific moment in the life of every control system when it crosses a threshold, a point after which it no longer needs its original architects to defend it. It defends itself. It self-reinforces. It becomes, in the most precise sense of the word, inescapable. The Federal Reserve's algorithmic cage crossed that threshold quietly, without announcement, somewhere between 2015 and 2020. And it did so through three mechanisms so deeply embedded in modern financial infrastructure that removing them would now require dismantling the system itself. The first mechanism is dependency at scale. By 2023, over 93% of all American workers received their income through direct deposit, meaning their wages arrived not as physical currency they controlled, but as digital entries in a bank account monitored by the Federal Reserve's network. This was not forced. No law required you to accept direct deposit. But the systemic pressure was total. Employers offered it. Landlords required bank accounts. Utility companies demanded automatic payment. Government benefits arrived digitally. The cage did not lock you in with chains. It made the outside of the cage uninhabitable. Cash became inconvenient, then suspicious, then, in many contexts, impossible. When 85% of global transactions are now conducted digitally, opting out of the monitored financial system is not a choice, it is economic exile. The second mechanism is regulatory capture, the process by which the institutions designed to oversee the Federal Reserve became, over decades, financially and institutionally dependent on it. The Fed doesn't just control monetary policy, it supervises the largest banks in America. It conducts the stress tests that determine whether those banks can operate. It sets the capital requirements that govern how much risk they can take. And the banks being supervised? They fund the Federal Reserve's regional operations through mandatory stock subscriptions. The regulator and the regulated are financially intertwined in a closed loop that makes genuine independent oversight structurally impossible. In 2010, the Dodd-Frank Act, passed explicitly to rein in the Federal Reserve after the 2008 financial crisis, ultimately granted the Fed expanded supervisory authority over systemically important financial institutions. The sovereign pattern repeated itself with clockwork precision: crisis, response, expansion. The cage nearly collapsed in 2008. The response was to build more cage. The third and most inescapable mechanism is the coming architecture of the digital dollar. The Federal Reserve has been quietly developing a central bank digital currency, a CBDC, since at least 2020, when the Boston Fed launched Project Hamilton in partnership with MIT. A CBDC is not simply a digital version of the dollar. It is a fundamentally different kind of money. Programmable money, money that can be coded with conditions, expiration dates, spending restrictions, and automatic compliance triggers built directly into the currency itself. Think carefully about what that means. Today, the algorithmic cage monitors your transactions and can intervene. With a CBDC, the intervention becomes automatic and absolute. Your digital dollars could be programmed to expire if unspent by a certain date, forcing consumption and eliminating saving. They could be restricted to approved categories of goods, making it impossible to spend on anything the system has not pre-authorized. They could be instantly frozen the moment a flag is triggered. No court order, no notification, no appeal process. The calculus of this architecture is staggering in its completeness. Every previous version of the cage required at least some human decision-making in the enforcement chain. A CBDC eliminates the human entirely. The algorithm is the judge, the jailer, and the key, and it operates at a speed and scale no human institution can challenge in real time. This is why the system is now self-sustaining. Not because of any conspiracy, not because of any single decision made by any single powerful person, but because the infrastructure has become so deeply load-bearing, so woven into the fabric of how money moves, how wages are paid, how commerce functions, that the cost of removing it exceeds what any political system is willing to pay. The cage does not need guards anymore. It needs only your continued participation. And participation at this stage is no longer truly optional. Every generation produces its rebels. People who look at the cage, recognize it for what it is, and decide, with genuine conviction, that they have found a way out. And every generation, the cage does something far more sophisticated than punishing them. It absorbs them. It studies their escape route, closes it, and uses it to build a stronger wall. This is not a metaphor. This is the documented, repeatable, systemic history of every serious challenge to Federal Reserve financial control in the last 50 years. The first great escape attempt came in the 1970s, when Americans, watching inflation destroy their savings under a Federal Reserve that had just severed the dollar from gold in 1971, began moving wealth into physical assets. Gold, silver, land, things the algorithm couldn't touch because they existed outside the digital system entirely. The response was precise and devastating. By 1986, the IRS had implemented comprehensive precious metals reporting requirements. Dealers were required to report large transactions directly to the government. Capital gains taxes on gold and silver were set at the highest collectibles rate, 28%, making physical asset accumulation systematically less efficient than staying inside the monitored financial system. The escape route wasn't blocked with a wall. It was made expensive, inconvenient, inefficient, and most people, faced with friction, returned to the path of least resistance. The second escape attempt was more sophisticated: cryptocurrency. When Bitcoin launched in 2009, born directly from the 2008 financial crisis, explicitly designed as a sovereign, decentralized alternative to Federal Reserve money, it represented the most serious architectural challenge to centralized financial control since the Federal Reserve's creation. For the first time, it was theoretically possible to store and transfer value outside the monitored banking system entirely, with no intermediary, no reporting requirement, and no algorithmic gate. The cage's response took approximately a decade to fully deploy, but when it arrived, it was overwhelming. By 2021, the Infrastructure Investment and Jobs Act had redefined broker in U.S. tax law to potentially include cryptocurrency miners, validators, and software developers. People with no ability to collect the customer information the law now required them to report. The IRS issued guidance requiring every crypto transaction, regardless of size, to be reported as a taxable event. Exchanges operating in the United States were required to implement the same Know Your Customer protocols as traditional banks. The Financial Crimes Enforcement Network proposed rules that would require reporting of any crypto transfer over $3,000 to an unhosted wallet, meaning any wallet you personally control. The escape route had been mapped, studied, and methodically enclosed. And here is the detail that reveals the true calculus of the system. Bitcoin's market capitalization reached $1.2 trillion at its 2021 peak, and rather than representing a threat to Federal Reserve control, it had by that point become a fully integrated, fully surveilled, fully taxable asset class sitting inside the very financial infrastructure it was designed to replace. The rebels had built a new room inside the cage and called it freedom. The third and most recent illusion of resistance is the political one: the belief that the right legislation, the right election, the right congressional hearing can fundamentally restructure Federal Reserve power. In 2010, after the most serious financial crisis since the Great Depression exposed catastrophic failures in Federal Reserve oversight, Congress passed Dodd-Frank, the most sweeping financial reform legislation in generations. It created new regulatory bodies. It mandated new stress tests. It promised, in the explicit language of its sponsors, to end the era of too big to fail. 14 years later, the 5 largest American banks control a higher percentage of total banking assets than they did before the 2008 crisis. The Federal Reserve's balance sheet, which stood at approximately $900 billion before 2008, had expanded to nearly $9 trillion by 2022. The reform that was supposed to shrink the system more than tripled it. This is the inescapable logic of the sovereign sequence. Every serious resistance produces the justification for the next expansion. The system doesn't fear challenges. It feeds on them. Every crisis becomes a mandate. Every reform becomes a mechanism. Every escape route becomes a new corridor of the cage. The rebels weren't wrong to resist. They were wrong to believe the cage had an outside. Because the cage was never just a financial structure. It is an infrastructural one, woven into the way wages are paid, the way commerce functions, the way governments collect taxes and distribute benefits. You cannot legislate your way out of infrastructure. You cannot vote your way out of the pipes that carry your money. And the next expansion of those pipes, the one being built right now, will make every previous version of the cage look primitive by comparison. You've made it to the end. And that tells me something important about you, because most people don't. Most people encounter information like this, feel the discomfort of it, and quietly close the tab. Return to the familiar. Convince themselves that someone, somewhere, has this under control. That the system, despite all evidence, is fundamentally oriented toward their well-being. You stayed. Which means the question now is not whether the system exists. You've seen the architecture. You've followed the calculus from Berlin in 1914 to Washington in 2024.